Have you ever felt like the market was playing with your emotions? One moment, you're euphoric as your trade skyrockets, and the next, you're gripped by panic as prices suddenly turn against you. If this sounds familiar, you're not alone. Every trader, whether beginner or seasoned professional, experiences the emotional highs and lows that come with market volatility. The real question is, how do you manage these emotions without letting them control your trading decisions? Understanding the emotional cycle of market volatility is crucial for long-term success. While market fluctuations are inevitable, your response to them determines your profitability and resilience. In this video, we'll dive deep into each phase of this cycle, equipping you with strategies to maintain control, even when the market seems uncontrollable. The emotional cycle of market volatility often begins with euphoria. When the market is moving in your favor, confidence surges. You start to believe you've mastered trading and the urge to take bigger risks creeps in. This is where many traders fall into the trap of over-leveraging or abandoning their strategy in pursuit of quick gains. At this stage, many traders develop what's known as illusion of control bias, a cognitive bias that makes them believe their recent success is purely a result of skill rather than a mix of skill and market conditions. The danger? Euphoria blinds you to the reality that markets are unpredictable. What feels like a never-ending climb is often just the precursor to the next emotional phase: anxiety. The best way to counteract euphoria is to stick to your risk management rules, no matter how invincible you feel. Successful traders know that every winning streak will eventually be met with losses. The key is to prepare in advance. As soon as the market starts to show signs of reversal, anxiety kicks in. Doubt creeps into your mind. You find yourself watching your screen more obsessively, questioning whether you should exit or hold. This stage is critical because how you handle this anxiety determines whether you transition into fear or regain control of your mindset. Anxiety often leads to hesitation. Traders may freeze, unable to make decisions, or they may start adjusting their stop losses prematurely, cutting their profits short. Anxiety distorts rational decision-making, making it essential to rely on predetermined trading plans rather than emotions. One way to navigate this stage is to focus on process-based thinking rather than outcome-based thinking. Instead of worrying about whether this specific trade will be a winner, remind yourself that sticking to a well-defined plan over time is what ensures success. Fear is one of the most destructive emotions in trading. When a trade moves against you, fear pushes you to exit prematurely or make impulsive decisions. This is when many traders abandon their strategy, take unnecessary losses, or worse, revenge trade. Fear manifests in different ways. Some traders may experience loss aversion, the tendency to hold on to losing positions for too long, hoping for a reversal. Others may panic sell at the worst possible moment, locking in unnecessary losses. Recognizing how fear affects your decision-making is the first step in overcoming it. Instead of acting out of panic, traders who succeed in the long run stick to their plan and reassess their risk management approach. Deep breathing techniques, stepping away from the screen and focusing on long-term probabilities rather than short-term fluctuations can all help mitigate fear. If fear is left unchecked, it evolves into desperation. At this stage, traders start making irrational decisions. Some increase position sizes to recover losses, while others jump into trades without a solid setup. The market, however, doesn't care about emotions. Desperation often leads to even greater losses, pushing traders into the next phase, capitulation. Traders experiencing desperation often exhibit sunk cost fallacy, a psychological tendency to continue investing in a losing position simply because they've already put money into it. This is a dangerous mindset that can result in severe drawdowns. To avoid this, it's crucial to have a predefined maximum loss threshold per day or week. Once that limit is hit, stepping away from the markets can prevent desperation-driven decisions. Capitulation happens when a trader is so mentally exhausted that they give up entirely. This is when traders close all positions out of frustration, stop trading altogether, or convince themselves they'll never succeed. But what many fail to realize is that this phase often signals the best opportunities. Markets move in cycles, and just as traders emotionally cycle through euphoria and fear, financial markets cycle through expansions and contractions. Recognizing this can prevent you from making emotionally driven decisions that you'll regret later. If you find yourself in capitulation, take a break. Analyze your past trades objectively and remind yourself that every great trader has experienced this stage. The key is to learn and come back stronger. Once the emotional storm has passed, clarity begins to return. Traders who accept that losses are part of the game are better equipped to adjust their strategies and manage risk effectively. This is when learning happens, when you can reflect on past mistakes and implement changes that prevent future emotional trading. Acceptance doesn't mean ignoring losses, it means embracing them as part of the journey. By developing a resilient mindset, traders can bounce back and refine their approach rather than being emotionally wrecked by downturns. The best traders are not the ones who avoid emotions, but the ones who learn to manage them. Developing emotional discipline is the true key to navigating market volatility. Have a clear risk management plan. Stick to your trading strategy even in times of uncertainty. Take breaks to prevent emotional fatigue. Journal your trades and emotional responses to recognize patterns. Surround yourself with traders who reinforce good habits. By following these principles, traders can cultivate emotional resilience and prevent volatility from dictating their decisions. Once you understand the emotional cycle of market volatility, you gain an edge over traders who react impulsively. Instead of being swayed by the market swings, you'll recognize when you're feeling euphoric and rein yourself in, or when you're fearful, and remind yourself to stick to the plan. Awareness is power. Journaling is an excellent tool for self-awareness. By documenting trades and the emotions felt during them, traders can identify recurring patterns and make adjustments before emotions take over. Market volatility is unavoidable, but being emotionally unprepared is a choice. The traders who thrive are not those who chase the highs and lows, but those who remain steady, regardless of market conditions. The more you understand the emotional cycle, the less power it has over you. How do you handle the emotional cycle of market volatility? Have you recognized any of these phases in your own trading journey? Drop a comment below and share your experiences. And if this helped you, don't forget to like and subscribe for more insights on mastering trading psychology.